And back to Al Fullerton from Aliom Financial Markets. Overnight, we have been discussing that the personal spending and income numbers out of the United States are pretty much unchanged, which means no pickup. Also, factory orders were down. We've got non-farm payroll numbers at the end of the week, and of course, joblessness is obviously at the heart of the spending and the income issues. We've been talking for so many weeks about the US double-dip recession. Where you stand on that?
I strongly believe that we're moving away from that hysteria that we're going to go back into a double-dip recession there. I think that what we're seeing here is a reflection that people are sitting on cash, and I think quite rightly so. If we were on the ground in the US, there are far more nerves over there than there are back here in Australia, and so the spending's not there because people are quite happy to sit on cash, and that's going to trickle down through the economy there.
You mean consumers are sitting on cash?
That's correct, yes.
But that's, in the short term, that's no good for the US economy. Is it longer term? Great.
Yes, that's right, and I think...
So why does that dispel any double-dip fears?
I feel that we're still an expansionary side over there. We're seeing the numbers that are coming out, they're still in expansionary territory. I think, as we spoke about, let's wait for trends to set in. We can't take these numbers as one-offs. The people are long cash at the moment, and that's quite a good place to be in. Will it improve? We've seen some good reports come out. The reporting season has shown that there are some positives in there, there are some negatives in there, and it's uncertain. So, let's really wait and see, but I can't see what the key catalyst is going to be to drop the entire US economy back into this recession, because I feel that certainly that with the alleviation of some of these European fears in there, we've seen a bit more risk come onto the table. Granted, we've seen some profit taking of late, but we have seen a more positive sentiment in both consumer and investor in the US and in Europe. So I continue to see that trait moving forward. Except
the very fact that we've been discussing second round of quantitative easing from the Fed. The market moved on that today. We've had pressure on the US dollar. I mean, that would seem to suggest that they don't think that they're so easily going to skirt a double-dip recession. No,
true. If we look at a month ago, if those comments were made by the Fed, the market would have gapped 1-2%. If data came in softer, the market would have fallen
significantly. People say the Fed's leaking it to the media.
Well, yes and no. I mean, the one comment about the Fed I like, is that Bernanke should perhaps, be a bit more of a general and rally his troops rather than making these bearish comments. We know that there is an uncertain outlook in there. What I'm looking for Bernanke is to say, well, this is how we're going to get out of that. These are our thoughts.
That's how it is. It's unusually uncertain.
You can read that in the paper. I mean, that's the thing. I mean, he's just sort of reiterating what they're reading on the front page of the New York Times and the Wall Street Journal. Well, we know that. What are you going to... the Fed, what is the Fed saying what we should do? Should we be going out there spending our money? Should we be doing this? Let's get a bit more of positive sentiment. Being a big bear and a fund sheriff doesn't help anyone.
Yes, I guess if... I don't think anyone wants him to sugarcoat it, though, right?
Yes.
So, I mean, you're saying, what are they going to do? You want to know what they're going to do. Are you even convinced they do know what they're going to do?
Well, yes, I do. I think that, the fact is that they are in expansionary conditions over there. They are growing. Yes, it is slow. Maybe it's not happening as much as we would like, but if we look at this reporting season and we look at where the market has been reacting of late, a month ago when bad news came across in Newswise, it was seen straight away as a doomsday scenario, that they were going to collapse and they were going to go straight back into a double-dip recession there. That was the instant market reaction. Now it's taken more in their stride. People are taking more in their stride. We saw it last night in the market there. The market closed basically flat, and that was from some pretty negative news or nothing really surprised to the upside there. So, in my opinion, people are taking it more and more in their stride now, and they're absorbing this negative news, and they're perhaps having a slightly more bullish sentiment.
Except, again, coming just back to a comment we made maybe at the top of the show, conviction. Still lacking. You haven't got those institutional players in there really buying up and being involved.
I agree, but it is a seasonally light time in markets. It's still a holiday season up there. So, I mean, let's not forget that there are other factors that will contribute to these volumes being light there. And we'll see this in the Aussie market too. We've seen light volumes over here, and we've seen reactions being magnified because liquidity just isn't there. And so August is historically a great month in the Australian markets there, and our reporting season will give us a chance to focus domestically as we've spoken about. So, I strongly feel that we'll manage to we'll see some good results from some companies. We'll focus domestically, and I see August as being a strong month for Australia.
Something that's, I guess, somewhat of distraction at the moment for markets is the election 2010 campaign. It continues to make headlines. Big business has been in the headlines today with various policies.